to make profits in Forex. You are either buying or selling. You can make profits from either buying or selling. And I mentioned at the beginning that the difference between Forex and stocks is that in Forex, you can make money from buying. You can also make money while selling. But stocks, you can only buy. Then when the price appreciates, you sell off your stocks or you make money from what we call dividend. However, in Forex, when the price of an asset or a commodity or a future, whatever it is you are trading, when the price is decreasing and you are in that market selling, you can make money. When the price is increasing and you are in that market buying, you will also make money. So in Forex, how do we make money? How do we make profits? We buy when the price of that asset is low, so that when it goes up, you can make profits. What that means is that you are buying it when it is cheap. That's why we say buy when the price is low. You are buying when the price is cheap. And then when it appreciates, you will make profits. Then you sell when the price is high. Definitely, why the price is high, there will be so many factors coming into play to ensure that the price starts dropping. And when the price starts dropping, you will be making money. That's the summary of how to make money from Forex trading. Now, in the other way around, when you are buying and then the price, instead of appreciating, the price is decreasing, you will find out that you will be losing money. Also, when you are selling and then you discover that the price is increasing, you will be losing money. Now, this is not strange to us in the world of business. In the world of business, the same thing happens. For example, for anyone who is into goods and services, let's say you have stocked your store with some goods at a particular price, and then suddenly the price of that commodity or the price of that goods falls. You will be compelled to sell that goods at a lower price, and it is possible that you might lose money. But do you know the beauty of Forex is that when the opportunity to make money comes in Forex, it is limitless. It is unlimited. You maximize the profit. You take advantage of the profit. When the opportunity to make profit comes, it is unimaginable. You can make as much as you can. The risk to the reward ratio is very, very, very good. That's the beauty of Forex trading. And this is where you need to understand the skill. You must understand the skill and know how to apply the skill and the technique in trading. The risk against the reward, unlike any other business, unlike any other investment, the risk against the reward is not proportional to each other. The reward is always very high. Unlike a good seller who has stock his shop with some goods, he can't sell beyond certain price. No matter how much he want to make money, he knows he has other competitors. The shop opposite him is selling the same thing he's selling. So he knows that if he puts too much of profit, customers will go to the next shop. So he always manage and control his profit. But Forex is not like that. You don't manage your profit, you don't control your profit. The only thing your job is to control your loss. Please take note of this. Write this down very boldly in your journal. My job is to control my loss, while the market will bring in the limitless profits and opportunity that is there. The reason why many people are still struggling with trading today is because they have not been able to master the skill, the technique. Many of them are even good with the analysis, but the psychology aspect is where the problem comes. So your job, our job as traders, is to control our risk, our loss. That is why I was emphasizing yesterday that ideally, if I am going to advise you, ideally, per trade, what you should risk is 1%. And if you have been trading before and you are listening to me right now, never trade without a stop loss. Never trade, because that is the only way you can control your loss. Yes, our job is to control our loss while the market, because you cannot actually tell what is going to happen next in the market. Even the market makers are only using the advantage of the volume of funds that they have to control the market. No one knows what is going to happen next in the market. We are only using history, event, reoccurrence of events to predict what could happen. It is just like if rain is going to fall, what are some of the indications? You are going to see cloud forming. Now, the probability that that rain is going to fall is 80% when you see the cloud. But do you know that at the end of the day, that rain may not fall? That is how it is. So, but when you see the cloud forming, the cloud is thick, the cloud is gathering, everywhere is becoming dark. Then with other signs, those who did geography, with some other signs, then you begin to say, oh, it's going to rain. However, it might eventually not rain. But the probability that the rain will fall is because of those signs. The same thing applies to Forex. All the analysis we use in trading, they are just giving us an indication, a higher probability that it is going to happen. It might eventually not happen. This is where you and I controlling our risk and loss comes in. What if it doesn't happen? How much am I risking? 1% of my capital, 2% of my capital. It must not be more than that per trade. However, when it is coming my way, how much do I want to stay? How much do I want to make? Well, that is now left to you. This is where the ability to control your greed and your appetite for profit comes in. The opportunity is limitless. It is limitless. But the risk is in your hand to control. So we make profits by buying when the price is low. We make profits by selling when the price is high. Now, the next thing is I'm showing you, look at the chart here. Can you see? This is how you begin to see the charts. Can you see that we are buying low at this area? We buy here and then price goes up. We sell here, price goes down. We buy here, price go up. We sell here, price goes down. And then while price is going up, you are making profit if you buy. When price is going down, you are making profit as you sell. Now the question is, how do I know when to buy, when to sell, how to buy, and how to sell? So now I'm going to show you the indicators that I use to trade. What are the things that I use to make my trading decision, which has been effective and it has been working? What are the instruments that I use? What are the indicators that I use? There are different thousands of indicators, thousands of strategies out there. You will hear people talking about ICT method. I have friends who use that method. You will hear people talk about SMC, smart money, all kinds of method. But I have discovered that those things are just a reinvention of what has been. The traditional method is still the best because it is very simple to understand, simple to grab, easy to apply. Very, very simple to understand, easy to apply, and easy to grasp. So before I go into highlighting and mentioning those indicators and instruments that I use to analyze the market, let me show you some other things, some other charts to see how you buy when the price is low, then you sell when the price is high. Remember that I mentioned that there are two types of trend. We have the bullish trend and then we have the bearish trend. The bullish trend is when price is going upward. It's called uptrend. Then the bearish trend is when the price is going downward and it is called the downtrend. As you can see in this chart, you can see price going up and then you can see where the sign is buy low, buy low. Now look at a bullish trend structure, uptrend. You can see the areas where the buying is coming in. Buying low, buying low, buying low, buying low, buying low. And then also look at the downtrend, which is called the bearish trend. Selling high, selling high, selling high, selling high, then selling high. Now, I'm now going to take you to a live chart and then I'll start showing you how we begin to know when to buy and then when to sell. I will mention those indicators and then in the course of the remaining days that will be coming for our sessions, I'll be explaining how to use them one by one. Just a moment. All right. Now, if you look at what is happening right now, this is I'm actually in this current trade that is going on right now. This is a live chart. I am in this trade where the price is my entry. The red that you are seeing, this is where my stop loss is, and my take profit is here. I'm going to explain how I came about all of this. But then let's take it one by one. What are the technical tools that I use to trade? Please take note of them. Number one, trend and trend line. Like I said, this is the traditional trading method. Very simple. It is not complex, easy to understand for a baby, easy to understand for an adult. Very, very simple. I use my trend and my trend line. Number two, I use chart pattern. Chart patterns. Number three, I use candlestick pattern. Number four, Fibonacci retracement. Fibonacci. Then I use moving average or simple SMA, simple moving average. These are the only technical tools that I use. So today I'll just take more of the trend and the trend line, and then subsequently we'll start looking at chart patterns, candlestick patterns, Fibonacci, and moving average. So please take note of this. They are very important. Now, listen to me. There are two types of trend. It has been mentioned before, and I am re-emphasizing it. The bullish trend and the bearish trend. When the price is rising, is increasing and going up, it is called bullish trend or uptrend. When the price is going down, it is called bearish trend or downtrend. And this is the rule. The trend should be your friend. The trend should be your friend. The trend should be your friend. And what do I mean? Trade in the direction of the trend. And what that means is when we are in a bullish trend, what are you going to do? You should be buying. You are looking for a buy. You are looking for a buy. When the market is in a bearish trend, what are you going to be doing? You are looking for your selling opportunity. The trend should be your friend. Never trade against the trend, except there is a breakout and a change in trend direction. And this can only be recognized by advanced traders. But for anyone who is still not consistent in making progress in Forex, don't trade against the trend. First of all, be the master of the trend before you begin to think about trading against the trend. So now let me draw how the trend always look like. In an uptrend, you will have something like this. In an uptrend, you will have something like this. Now, this point is called high low. High low. Why this point is called high in an uptrend? This point is called the high low. Why this point is called the high? So as a trader, you should be buying in an uptrend, you should be buying at the high low. And then you sell at high. That means you take your profit at high. You buy at the high low. Then you take your profit at the high. You buy at the high low. That means I am buying here, high low. I am buying here. So the question is, how do I know when the price gets to the high low and I am able to make my entry and take advantage of the next uptrend movement? That is the essence of why we are here. So, but this should be established to buy at the high low in an uptrend. You buy at high low, you buy at high low, you take your profit at high. You take your profit at high. You take your profit at high. So the first technical analysis tool that I mentioned that I use is the trend and the trend line. Now, this is what the trend line is. This is the trend line. The trend line is the line that I draw to connect all the high lows together. So I connect 2 or 3 high lows, 2 or more high lows together. And that gives me an idea of the next area where the price is going to do the next high low, where the price is going to bounce and then it goes up again. Now, when the trade goes below the trend line, we call it a breakout. That trend has temporarily, and it could be permanent, has been altered. But as long as the trade is riding on your trend line, it has the momentum. It means there is enough momentum for it to go higher. Now, the same thing is for the downtrend. The same thing is for the downtrend. Now, this is it. In the downtrend, we have what we call the low high and the low low. Low high and then the lower low. Low high, then the lower low. The lower high, the lower low. Now, this is the trend line connecting all the lower highs together, 2 or more. And what that means is that as long as the price is below the trend line, there is a momentum for the trade to go more lower. So what am I looking for? I'm looking forward to pick my trade at the lower high for a sell. Lower high, lower high. So I'm selling at this area. That is about trend and trend line. So in our next class, which is tomorrow, we will talk about other technical analysis tools that I use and how to apply them. Now, this is the final note. You cannot use any of these in isolation. All these things I've just mentioned, the trend line, the chart pattern, the candlestick pattern, the Fibonacci, and the moving average. None of them should be used in isolation. That means don't just rely on one. For example, I use my trend line now. I still need to combine it with two or more, either with a Fibonacci retracement plus a chart pattern, or with a moving average and Fibonacci retracement. There must always be what we call a confluence. That means you are using three or more of these tools together to solidify and increase your potential in making good returns from that trade. So I don't want to bombard us with too much terminologies so that it can actually sink. This recording will be put in the community. You can watch it again, and get familiar with what we are learning. Now, look at a live chart here. This is a 1 hour time frame. This is a 1 hour. What exactly is the price doing at the moment? Price is trending low. Now, if you go to a higher time frame, like the daily time frame, what do you observe? What do you observe? You observe that the price is dropping. Look at it. This is the daily time frame. See price dropping. Look at my trend line. Look at another area here. So when I see something like this, now I've gone to 4 hours. When I see something like this, I see that price is dropping. I am not looking for a buy. I am looking for an opportunity to sell. So I'm using my trend line to see what is happening and how I can actually enter the trade. Then I go to 1 hour. I'm looking at a possible way to enter. I'm looking at a chart pattern. I'm looking at the structure. I'm looking at my moving average. I'm looking at what is happening, and I'm able to interpret and then place my trade. That's exactly how we do it. Very simple.